Well, good afternoon. Thank you for taking the time to join me in my year-end webcast titled Jump. Today's webcast will provide an update on my views and observations related to the economy, inflation, and various capital markets. This presentation follows my June webcast titled Gravity. In it, I suggested that the inflationary fiscal stimulus from the Biden administration was in the early stages of being reversed. Regarding monetary policy, I noted that the Federal Reserve would likely continue to be slow-going in the process of lowering the short-term Fed funds rate. As I'll make the case in the coming slides, I continue to find high-quality fixed income assets attractive. In the equity markets, I favor value over growth and international over U.S. equities. An allocation to commodities continues to remain prudent in the current environment as an inflation hedge as well. This being noted, I'm also on watch for the large cap growth sector of the U.S. equity market to shift from being a secular bull market that started at the end of the 2008 financial crisis to go back into a secular bear market in the coming year. In the near term, I no longer consider gold and silver undervalued. Both precious metals are now up approximately 400% over the last decade. In my view, both precious metals are due for some consolidation and corrective action in the coming year. Today's webcast is being recorded and will be available for replay. As always, if you find today's webcast helpful but have questions about any of the content as it pertains to your investment strategy, don't hesitate to reach out to me or one of my partners following the webcast. Also, if you'd like an electronic copy of today's slides, let me know and I'd be happy to send you a copy. As a reminder, those who get an electronic copy of the webcast can go back and watch prior webcasts that you see here on this screen. You just click on the link there and it'll take you directly to the recording link. Also, I'm planning to start doing these webcasts on a quarterly basis, and my next one will be on April the 22nd, 2026. On a final housekeeping note, these webcasts are designed to update clients that include accredited investors, high net worth investment advisory clients, as well as our qualified plan sponsors and their plan participants. This webcast will be another three-part presentation that provides an update on economic growth, inflation, and both monetary and fiscal policy in Section 1. In Section 2, I'll cover market risk and opportunities. And then in Section 3, I'll provide a first half 2026 outlook. As a reminder, I don't profess to know the future, but that doesn't mean we shouldn't continually study the past and use the past to inform the present when managing risk in one's investment strategy. So with that in mind, let's get started. To start, let's note that it's been another good year for investors. Year to date, the S&P 500 is up approximately 18%, while international equities are up between 25 to 30%. So I mentioned at the start, gold and silver have done extremely well over the last decade and are among 2025's top performing assets, at plus 60% in the case of gold and over 100% in the case of silver. Fixed income investors, too, have had a decent year, with returns ranging from 5 to 13%. One final observation is that historically, equities are down 1 out of every 4 years on average. 2022, as you can see from this chart, was the last down year, and now we've witnessed 3 strong up years in a row. Equally important, there's only been 2 down years in the blue chip S&P 500 index since the end of the 2008 financial crisis. This means U.S. equities have been up 15 out of the last 17 years, or in other words, 88% of the time. This observation, along with the fact that we are witnessing historically expensive equity valuations in the large cap growth sector in particular, has me on watch for the possibility of the next few years to be down years for the more overvalued areas of the equity market. Next, we're going to look at how the overall economy's been doing over the last several quarters as measured by real GDP growth. As a reminder, real GDP is a calculation that comes from adding up consumer spending, that's the letter C you see on the screen, investment spending on fixed assets, government spending, which is the G, and then NX is for the net exports. That's the things and goods and services we sell abroad, the value of that in a year or a quarter, less those things that we import. It's worth noting that also with GDP growing in recent quarters, it's forecast to continue to grow in the first several quarters of the year next year. And you'll also note from this chart that headline CPI continues to moderate, which is the Fed's goals to get it back down from that 9% reading that we saw in 2022. So we'll see in the next slide, Treasury market participants continue to expect the Fed to cut rates in the coming year. And you can see that here just by looking at what's called the implied overnight rate. You can see in the two-year Treasury note in particular, if you look out into the future and see the two-year Treasury note trading at a lower level than the Fed funds rate, that implies the Fed's being too tight with monetary policy and that the Fed's likely to cut rates. And from this data, it concludes that we should expect the Fed to cut rates another 50 basis points at some point in the new year. Speaking of the Federal Reserve, market participants are expecting President Trump to nominate Kevin Hassett as the next chairman. Kevin's on board with the president and Treasury Secretary Scott Bessent's philosophy that disinflationary economic growth should be the expected outcome from the Trump administration's economic policies. This too argues for continued loosening of monetary policy in the new year, assuming he's elected as the leader of the Fed come May. With my expectations for inflation readings to keep in check in the new year, I continue to find the higher quality parts of the bond market relatively attractive. This expectation being noted, I continue to believe that long duration bonds offer an attractive hedge against equity market drawdowns, assuming a disinflationary environment continues in the new year. As a reminder, when interest rates fall, bond prices and high quality bonds such as U.S. Treasuries historically move higher. So if long-term rates continue to stay well below the 5% level as I expect, 2026 may prove to be a rewarding for holders of the long duration Treasury market. Turning to the U.S. stock market, as I mentioned earlier, the S&P 500 is currently up approximately 18% on the year. In my June webcast, I noted that I expected the bull market to continue, but was at risk of running out of steam as we start a new year next year. The following slides will provide some context for this expectation. First, though, let's do a little market history. What we're looking at here is a 100-year chart of the S&P 500 index that goes back to 1926. And I think it's helpful just to note that over the long term, the reason why my industry claims that the stock market is a good hedge against inflation is that if you look at any 50-year time frame, you have outpaced inflation by a meaningful amount. On average, the S&P's delivered investors around 10% annualized returns over any given 50-year period. But I always think it's important to note, since very few of us have a 50-year holding horizon, I think it's helpful to look at the circumstances where we see meaningful deviations from that trend. So let's look at some of those. First, let's start with the time frames where we saw above average returns over long periods of time from that 10% average. So if we go back over here, on the bottom left part of this chart, that's the bottom of the Great Depression at the 1933 low. If you measure the return of the stock market from that moment in time all the way out 30 years into the mid-1960s, you actually did far better than 10% per annum. You actually made around 16% per annum. So your money was not compounding or doubling rather at every 7.2 years. It was doubling about every 4.5. Also, it happened again after the 1973, 1974 inflation crisis low. It caused the stock market to go down 50%. Investors would witness for the next 25 years, 16% annualized again, with a compounding of their or doubling of their capital about every 4.5 years. And then more recently, after the 2008 financial crisis low for the next 17 years through today, we've seen the same thing happen again. And of course, none of us complain about better than expected outcomes, but I think it's helpful just to observe really one important thing. Those outcomes all started with a financial crisis or a depression bottom that created below average valuations for the stock market. Now let's turn to the time frames where we saw the opposite, where returns were disappointingly poor. Same chart. We'll start with the peak from 1929. An investor there unfortunately had to watch their capital drop 90%. It was in the stock market and not break even for 25 years out in the early mid 1950s. It happened again, except for it was in an inflationary time frame from 1966 to 1982, where we saw basically no returns. But what you don't see on this chart is that inflation hurt your purchasing power as an investor about 70%. So your value of your dollars are about as damaged as the depression did to them. And then more recently to my career, the post-tech bubble bursting in 1999, early 2000, you'd see the stock market tread sideways for that 13-year period after both the 2008 financial crisis recession and the 2001 to 2002 recession tech bubble burst, and then not permanently get above its 2000 peak until 2013. And I think it's also helpful to know what was the circumstance leading up to these disappointing return timeframes. I think that's always helpful to get in our head what's going on there. Well, what we can clearly see is that leading up to them, in every instance, you had above average returns. So from 1980 to 2000, that was above average returns. As I said before, from the 33 low to the mid 60s, that was above average returns. And what you can't see leading up to 1929 was that back in the early 1920s, the stock market was cheap and had a pretty good run there for 9 years. Additionally, what was going on as well leading up to those time frames is that commodity prices had been flat to falling. That kept inflation at bay, but then inflation would start to pick up because towards the end of these bubble time frames, commodity prices would start to rise, and there was enough commodity inflation starting to get into the economy to cause inflationary pressures to rise, which caused central banks to start to tighten monetary policy. And then one final note it was worth noting is that those strong returns leading up to the peak caused investors to get complacent. Valuations got expensive and leverage got out of hand. And what we see today is exactly those circumstances. In other words, we have an expensive stock market. We do have a fair amount of leverage in our system. And then we also have monetary policy that's gotten tight from inflationary pressures from commodity prices rising. Now, again, as I said before, I don't have a crystal ball. I'm not claiming that I know the stock market's about to crash, but what I am telling you is that this is a time, in my opinion, to start looking for areas of equity markets, if you're an equity investor, that have more attractive free cash flow yields. And I'm going to talk about that in the coming slides. Now, let's look at where the areas of the most froth are before we get into that, or first. So you need to understand, number one, if you own an index like an S&P 500 or a fund that has a heavy weighting to similar companies, know that you're going to get a large percentage of your holdings in the largest companies. So for example, today, if you look at this top box, Apple, NVIDIA, Microsoft, now the Oracle, those are the largest market cap weighted companies today in a large cap index like the S&P 500. And if you get an idea of how big those companies are by looking at their enterprise values and add that up and divide it by the output of the United States economy in a year, those 10 names today are equal to almost 77% collectively of the output of the United States economy. Now, what does that mean? Well, let's go back in time for a minute. When we know for a fact, with the benefit of hindsight, when we had the tech bubble, if you add up the 10 largest companies by enterprise value, you'll see them here in the bottom, starting with Microsoft, going down to SBC Communications. Those market caps collectively added up accounted for 28% of the output of the US economy back then. And so what we know is back then that was a bubble. Many people today are saying, well, it's not a bubble now. These companies are making money. And I would say, well, that's true. But that doesn't mean that their prices are not extremely elevated and extremely rich in relation to their earnings stream. And that's the point I want to make, is that we've got this particular metric suggesting that we have almost 3 times the froth today in those particular names than what existed 25 years ago. So that's why I'm kind of throwing up a caution sign to maintaining them in your portfolio if you hold them. Now, what else gives me caution in the near term? I've been mentioning this particular slide for the last several webcasts, and I think it's helpful to look at because it's showing us several things. Number one, at the bottom, what we have is the Fed funds rate. That's this green line that you can see. So when the Federal Reserve drops interest rates like they did to ease monetary policy when the tech bubble burst, you see that happening there. You see when the economy recovered in 03 and 4 and 5, how they raised short-term rates. And then you can see how long they were held at or near zero post 2008. And then you can see how they responded to inflation in 2022 by raising rates. And then here they are again, cutting them slowly. Now, what's in the top panel of this chart is you're seeing several things. The blue line is the S&P 500 going back to the early 90s. And I think it's helpful to see this relationship to how the S&P does when financial conditions are loose and when financial conditions are restrictive. So how do we know when conditions are loose or restrictive? Well, that's how I show that by looking at this black and red line. That's an indicator measuring the difference between the short-term 2-year Treasury note yield and the longer-term 10-year Treasury note yield. And what you see is that when the 10-year Treasury note yield is well below the 10-year Treasury note yield, that's an indication that financial conditions are loose. Anytime you see that happening historically, you're going to see this black and red squiggly line above the green horizontal line. That's because the spread's well above 2% between the 2-year note yield and the 10-year Treasury note yield. When that's happening, when financial conditions are loose, banks are able to make money in lending, so they tend to lend more. And you see when that's happening, more borrowing and lending happening, and you tend to see the economy growing. And when that's happening, you usually see, guess what? The stock market going up. So let's look at the case of that being the truth. You got right here, this first episode in the mid-90s. What's the stock market doing? It's going up, even as financial conditions become less and less loose and eventually get restrictive. Now, what happens though when financial conditions get restrictive enough, long enough, by the yield curve getting inverted, that's a period of time where short-term rates are above long-term rates, you start to see the economy slow and eventually earnings expectations fall short and the stock market usually peaks. And that varies. It can be 9 months, 6 months, 12 months. And in the most recent case, it's been 24 months and counting. All I'm trying to point out is that in today's environment that we're in, if you just stated the fact that historically when financial conditions are loose, the stock market's usually recovering from a downtrend. And when financial conditions are restrictive enough, long enough, you start to see the stock market get in trouble. Notice that financial conditions have been very restrictive, very deeply restrictive, because we had a very deeply inverted yield curve for over 2 years that's just now becoming uninverted. And when you see that uninversion happen, that usually tells you you're getting close to a peak in the stock market historically. Now, what's the point of knowing that? Well, knowing that history and knowing how that applies to not just the last 30 years, but even going back to the Depression, I just want to point out the fact that the yield curve, as I said before, had been inverted longer than any previous period, even that which led up to the 1929 peak. And there's a correlation to equity market drawdowns happening eventually that are in correlation to the length of the yield curve's past inversion. So all I'm trying to say is that without a long yield curve inversion, we should expect a bigger than normal drawdown in the stock market, particularly with it being as expensive as it is in the large cap space, in particular, at some point in the future. Now, why do I say the stock market's expensive? I think it's helpful to look at and try to explain a way you can look at the stock market the way you might look at a bond as a fixed income investor. So what we know is, for example, today, my banker calls me up and says, hey, T, we've got this great money market fund that's yielding 1.5% that you can put your money into right now, and you're making zero in your checking account. You think I'm interested? No. Why would I not be interested? Well, here's what I know. I can make in a money market fund anywhere from 3.6 to 3.8% risk-free. So if somebody tells me they can make me half that, I'm not that excited. Well, the way you apply that to looking at the stock market is you can look at what we call the free cash flow yield. Think of the free cash flow yield as the money that's in the bank today in a company, or in this case, the entire index of companies in the S&P 500, comparing that to the cash in the bank collectively a year ago, and then dividing that by the value of the company. So over time, if you think about as an investor, what causes the value of our stocks to go up is earnings growth. And earnings growth, of course, means they're making money after tax, meaning they have cash in the bank. That's more than they had last year. And sometimes they elect to pay some of that cash out to us as a dividend. Well, the short version of this chart is that when investors have gotten 10% annualized returns historically, the free cash flow yield of the S&P has been at least 5.5% or more. And today it's below 3. So the reason why I say my return expectations for the stock market are low because it's expensive is because when I look at this chart, it's telling me the rate or the yield on it is low. And if you think back to where we were in 2008, when the best buying opportunity came to us in recent history, in hindsight, what we can see is the free cash flow yield was where? It was above 8. And so investors were being compensated immensely well above that historical average, and that helped to generate that above average return on a going forward basis. So what does all this mean? Well, I'm not telling you not to invest in equities. I'm just saying be careful what equities you choose to invest in, because there's other areas, as we'll see in a minute, within the global equity markets that have more attractive free cash flow yields. So where you look for those is number one, understand where they're expensive. That's going to be in everything that's going to be oriented around large cap United States focused, Russell 1000, S&P 500, NASDAQ. That's going to be where those most expensive names are I mentioned earlier. And if you look at other parts of even the U.S. market, for example, in large cap value, small cap value, international value, emerging markets, and emerging market value, those all have free cash flow yields that are 5% or higher. So in those areas, you'll likely see, if history is any guide, better future returns on a going forward basis. As a matter of fact, we saw that this year. At the very beginning, you heard me say, U.S. is up 18 looking at the S&P, which is not a bad year all, of course. But I also noted that international and emerging markets were up between 25 and 28%. So that's been a good thing, obviously, to hold in your portfolio. One other thing, even though I mentioned at the beginning that since gold and silver have gone up 400% in the last decade, I think it's helpful just to note, because I know there's a lot of investors that have not held gold or gold mining equities in their portfolios. And I think it's just helpful just to observe, if you go all the way back 25 years ago, how's gold done as a diversifier and say against an index like the S&P 500? Well, it's done twice as good. The S&P 500 is up around 500% on a total return basis. Gold's up over 1,000% on a total return basis. And of course, doesn't even pay a dividend. So I mentioned that really for two reasons. One, when we think about owning diversification or diversified assets against our stocks, Many of us naturally gravitate to bonds, which is not a bad thing. But one other non-correlated asset that's often not thought of to fixed income holdings like bonds are precious metals, and gold's a precious metal. So that again is just a comment that I think is helpful for further investigation if that's not something you've considered in the past. One other reasoning behind that before I go back and change subjects on you again is really looking at this relationship between the performance of the stock market historically as a ratio to the performance of the gold price. Now, we're going to use the Dow Jones Industrial Average here because it goes back the furthest in time into the early late 1800s rather. And what this chart is doing is just taking the price of the Dow Jones Industrial Index and dividing it by the gold price. Now, during a lot of this time frame, virtually all of it preceding the Depression, gold was fixed at a price of, I believe it was $24 per ounce. And you can see that it didn't do anything. So if the stock market's going sideways, that just means the stock market's going sideways. And in this case, stock market's going up. But then, of course, as I mentioned before, we get the crash going into the Great Depression into the 1933 low. The stock market goes down 33%, and gold gets revalued up 50% during that era. So gold protected investors, and then the stock market recovers and does great for the next 35 or so years. But then, as many of you may be aware, we got off the gold standard in 1970. And during the time frame where the stock market went nowhere from 1966 to 1982, the price of gold would go from $40 an ounce to $850 per ounce, which is why you see a big drop in this ratio, because the stock market's flat, but the price of gold is up 25x almost. Then you see from 1980, the stock market does well again, and the price of gold actually goes down by about 65%. And then you note that this ratio breaks down again as the tech bubble's about to burst. Whereas the price of gold right there, it's at about $250 an ounce. The stock market for the next 13 years, remember, is about to tread sideways, yet the price of gold's about to go up 4x. Now, these red trend lines are interesting just to make a note in time, because when you see that breakdown between the stock market starting to underperform the gold price, that's telling you you're likely now early in a commodity upcycle. And we just witnessed that happening again, not because the stock market's gone down, but actually just because the gold price and commodity prices are going up more than the stock market. And so I'm suggesting to you this really one thing. Again, I don't know the future, but using the past as a guide, once these trends start, they usually go on for multiple years. It would be my expectation that at a very minimum between now and the end of this decade, in other words, to 2030, you would see commodity prices and gold prices outperform the stock market based upon past propensity. Now, let's go to the near term. Said earlier, I expected gold and silver prices to start to correct in the new year. Well, what does that mean for gold and silver mining companies, which are up about 150% on the year? Well, gold and silver mining stocks correlate to the price of gold and silver. So gold and silver can go up, as they did this year, 60 and 100%, and gold mining stocks can go up 150%. So in other words, they're levered to the price of the underlying metal. I would also tell you, if we see some consolidation where, let's say if gold consolidates and goes down 25%, let's say silver goes down 30 to 50% next year, I have no idea if that'll happen, but let's just say they do. I would fully expect precious metal mining companies to go down more than those two numbers, maybe 50, maybe 60%. So I've taken profits in my personal positions in those companies, happy to pay tax in doing so in taxable accounts, and in non-taxable accounts, of course, it's not an issue. But I am telling investors that now is not a good entry, in my opinion, compared to several years ago when they were trading cheap. And I would just say that history suggests that we might get better entries in the coming year. Another reason why I expect that be a possibility is the dollar index. you're looking at a chart of the US dollar index that's really going to move based upon how the dollar is doing versus the euro and the yen. This chart goes back to the late 90s. And so when you see the dollar index going up, that's mostly meaning that it's strengthening against the euro and the yen. And when you see the dollar index falling, that means it's weakening against those two currencies. And you'll also notice too, if you can remember, when the dollar was weakening between 2000 and 2008, commodity prices are rising. Matter of fact, the price of oil is going from 12 to 150 a barrel during that decade. But when the dollar stopped dropping, we were getting close to a peak, at least in the near term, for commodity prices. So in 2008, for example, when we had the financial crisis, gold went down 25%, oil went down 65%, silver goes down, I think it was around 50%, and just about everything outside of US Treasuries goes down in price. And I'm not forecasting a financial crisis next year. What I'm just trying to suggest is that if the dollar holds in this rising trend channel and starts to turn back up, that's likely to be in a scenario where we're starting to see some credit strains happening somewhere in the global financial system, which wouldn't surprise me considering how long financial conditions have been restrictive. And so if that were to happen at some point in the new year, I would just simply suggest to you that that's usually when we see corrections in those two precious metals, which again goes back to why I took profits earlier this year. So in summary, just a couple of things again to reiterate. US Treasuries continues to be, to me, a good safe haven to hold some fixed income. Other high quality fixed income is fine, mortgage-backed securities and high quality corporates I wouldn't rule out. Just be wary or be cognizant of if you own high yield bond funds. High yield bond funds tend to drop in value when you see liquidity problems in the system. So if we were to see that, don't expect those types of bonds in the near term to perform well. I also would just simply suggest that since US Treasury yields are higher than large cap growth free cash flow yields, when you've seen that historically, it's not uncommon to look back in history and see risk-free rates to have done better than low free cash flow yielding parts of the equity markets. And again, I think about the mega cap names in particular because they're priced so richly. I want to use Cisco Systems back 25 years ago. Cisco got extremely overvalued because they were the main dominant seller of routers when we were building out the internet. And when you saw their March earnings release happen, they actually made money. But investors were expecting earnings growth that was much higher than what they announced. And what's interesting is that Cisco kept making money with the exception of a quarter or two in 2001 over the next several years, and their revenue growth would continue to grow, but yet their stock price would go down 90% over a 30-month time frame, and the stock market would go down 50% back then while the economy grew 14%. So don't assume just because I'm suggesting to you that it looks like the economy's fine and the economy is going to continue growing, that all parts of the stock market should keep doing well. My expectation is that next year it'll probably be a widely divergent market as it relates to what does well and what doesn't do well. And if I were to guess those places that could fare well in 2026, I would be looking to, again, value, international value, emerging markets value, simply because, again, they've got more attractive free cash flow yields relative to the large cap growth component of our US stock market. A final note for those of you that are interested in some additional video related commentary is thought it would be interesting. Speaking of the tech bubble bursting, there's an interview, if you get a copy of the slide deck, that you can watch Jeff Bezos, CEO of Amazon, comparing the current AI boom to the internet bubble. Amazon, interestingly enough, got impacted too, like Cisco did 25 years ago. They kept growing their revenue, as you'll hear him talk about, month after month. Their losses were dropping month after month, and their customers were growing month after month over that 3-year period, and yet their stock price would go down 90%. And so it's interesting just to hear his reflections back on that and how that pertains to today. The next interview is really about passive investing and the influence on passive investing from index investors buying through things like their 401k accounts, just without being valuation focused in their investment decisions, how much money flows into passively managed funds. And I thought that might be of interest to some of you. And then finally, for those of you that might be interested in thoughts on the federal government's debt, we have a great interview that's from a member of the House of Representatives that's in charge of the financial, really part of the House there in terms of leadership. That's talking about ways Washington can tackle the debt crisis, which of course will require everybody getting on board with it. But I thought that might be of interest to some of you as well. And finally, let me also just mention, again, in closing, if any of the content has made you want to do an account review and just kind of rethink some of the things that I've talked about, thinking about positioning with your account, don't hesitate to reach out to me or one of my partners. Also, if you're not a client and you're interested in seeing how to put some of these themes to work and how they would apply to your current investment strategy, don't hesitate to reach out to me. And then finally, as I mentioned to you earlier, the next webcast I'm going to do, since I'm going to quarterly, is going to be on Wednesday, April 22nd. So if this content's appealing to you, be on watch for a invite that'll come to your email box sometime in early April for the registration link for that. With that, I just want to again thank you for taking the time out of your day for joining in with me. I hope each of you have a great Christmas and happy and safe New Year's celebration. And with that, I look forward to talking to you again in the new year.
Bombadita, 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 bombadita,
until
bombadita,
we meet
bombadita,
again.
bombadita,
Happy
bombadita,
trails to you.
bombadita, bombadita,
Keep smiling until then.
Who cares about the clouds when we're together? Just sing a song and think about sunny weather.
Happy trails to you till we meet again.